Hello, teacher. We are Group 5, and today we will present the topic: Does financial integration cause more harm than good for emerging countries? This is our group member. We have 5 members. About the introduction, we have the story of financial integration of Vietnam. In today's era of peace, people no longer have to struggle for the survival of their country. Vietnam in particular and developing countries in general have escaped from the darkness of war to enter the period of innovation where economic development is the primary goal. The immersion and development of a market economy requires the expansion of national markets, formation of a unified regional and international market, because that is the only way to develop an economy. Moreover, the financial integration process is also an inevitable part of the international integration process. In the context of increasing strong financial integration, developing countries have been implementing many market opening policies, removing barriers to cross-border financial transactions. Vietnam is also opening up its market to attract international capital flows and promote economic growth step by step, but still be cautious about risk from adverse fluctuations in the global market. Shunning the integration flows of the times, we have participated in bilateral and financial relations. For example, Vietnam has joined AFTA, APEC, being the 7th member of the Asian Federation of Accounts and the 130 member of the International Federation of Accounts. Despite many challenges, Vietnam economy has taken initial steps to open up to foreign countries, participate and dominate foreign markets. So through the story of Vietnam, this report will depict some introduction, definition, benefits, drawbacks, and solution about the importance of financial integration. First, let's go to the definition. Initially, according to Brower in 2005, financial market integration is the process by which financial markets is an economy become more closely integrated with the markets of other economies. A country implementing financial integration often focus on some basic sections such as standardization of the legal framework for finance activities, building a payment and transaction support infrastructure system that is close to the regional and international standards, and the ability to connect the international market, financial liberalization and currency integration through the formation of a monetary union. About the history of financial integration, it is considered to have appeared since the 1690s and was briefly integrated at the beginning of the French Revolution. However, financial integration began to take shape in Europe during the classical gold standard era. Until then, the world witnessed a significant increase in financial integration in the 1980s and 1990s. Over the past 2 decades, there has been a significant increase in financial integration, and this generated lots of cross-border capital flows between industrialized countries and emerging countries. With rapid capital flows around the world, there are many controversies about the benefits and adverse influence of financial integration that we will present in the next session.
Well, then we will move to the next part, the drawback of financial integration in developing countries. First of all, about the net export, it is quite challenging for emerging countries to adapt whole standards that are regulated during the process of exporting, owing to their limitations in cell productions and material provided. Taking Vietnam, a prevalent emerging country in Southeast Asia as an example. In recent years, agricultural products have been returned several times because of their commitment to laws of safety, such as some products contain more plant protection medicines than permitted. And not only Vietnam, but also many emerging countries are still incapable of getting used to all of such complex regulations. Therefore, it appears to cause adverse effects like punishment or warnings about permanent export banning. Furthermore, sometimes these emerging countries have to care for the treatment of returned items, which consumes an amount of money. Secondly, we will talk about the internal productions. Financial integration means that the internal consumers adapt to external products, which can be inexpensive and high quality. Consequently, the consumers will use more foreign products rather than domestic goods, placing serious detriment on the consumptions of internal goods, especially emerging countries whose industrial products, such as clothes, are less impressive compared to foreign ones, which suffer a trend called foreign favor among the population. Thirdly, we will talk about the macroeconomic instability. Financial openness can result in huge capital inflows and have detrimental macroeconomic consequences, such as rapid monetary growth, inflationary pressure, and deepening current account deficits. Growing external deficits tend to cause currency depreciation under flexible exchange rate, which may eventually lead to a realignment of relative prices and a self-correcting adjustment in trade flow. In contrast, losses in competitiveness and developing external imbalance under a fixed exchange rate system can erode trust in the feasibility and durability of the peg, producing a currency crisis and eroding financial stability. And last one about the foreign bank entrance poses a risk. There is a possibility that foreign bank with lower operational costs may put pressures on local bank in order to remain competitive, thus forcing them to merge. Their understanding that banks are considered too big to fail or too political influence to fail, as monetary authorities might fear that the bankruptcies of a single giant bank will disrupt financial market and societies at whole. Although these potential issues might be avoided by increased prudential regulations or an outright prohibitions on mergers deemed to significantly increase systemic risk, they may result in a major expansion of the breadth and expand of the official safety net. A too big to fail problem might in turn exacerbate moral hazard issue.
So we'll move to the benefits of financial integration for emerging countries. The benefits derived from financial integration include effective allocation of productive resources, positive effect on capital flow on investment and economic growth, consumption smoothing via international risk sharing, and finally high efficiency and stability between the domestic financial system and foreign bank penetration. To begin with, financial integration can be able to increase productivity levels through more efficient utilization of resources and simple availability of investment possibilities, spurring growth in the economy. If having access to a broader base of capital is a major engine for economic growth, then financial integration is one of the solutions due to it facilitates flows of capital from developed economies with rich capital to developing economies with limited capital. In many developing countries, constraint to the capacity to save can be caused by low-level income. The net foreign resources inflow should complement limited domestic savings in capital pool economies, and by reducing the cost of capital, allow for increased investment. One of the most noticeable types of capital inflow is the foreign direct investment, FDI. FDI yields many benefits for emerging countries. Not only can add it to investable resources and capital formation, but perhaps more vital, it also acts as a means of transferring production technology, skills, innovative capacity, and organizational. This means that developing countries can benefit greatly from financial integration in a number of ways. As a result, over the last few decades, a number of emerging countries have started a quick approach to financial integration. The given barrier represent that financial integration grew significantly from 1970 to 2010, especially from 2000.
And now we'll move to another welfare advantage of financial integration, which is the lowering of consumption volatility. This is because financial integration enhances risk sharing through greater opportunities for investment diversification. By allowing households to hold more diversified equity portfolios, the risk portion that arises from country-specific shocks is further disseminated. Thus, countries can engage in risk sharing and consumption smoothing when borrowing abroad and holding foreign assets. What is more, the increasing opportunities to hold assets in other countries with different economic cycles provide a channel to lessen a slowdown in consumption during an economic downturn in the domestic economy. On the other hand, financial integration also helps emerging nations to increase their growth rate in other aspects. As greater availability of credit helps reduce precautionary savings and smooth consumption, there will be benefits for microeconomic stability. Additionally, wider access to finance also could help create opportunities for the poor. This financial inclusion is essential to the efforts to reduce poverty and income inequality. Under these circumstances, this result brings great opportunities as well as the potential for developing countries, since the ability to save is often restricted in emerging economies due to low wages level. As long as the marginal return from investment is at least equal to the cost of borrowed capital, net foreign resource inflows supplement domestic saving, increase level of physical capital per worker, and help the recipient countries arise its rate of economic growth and improve their living standard. Financial integration also drives benefits from the penetration of foreign banks. As you can see, we have a graph here that describes the trends in foreign bank entry that have a likelihood of increasing through each year. Efficiency gains contributed by foreign banks include reduction in cost structures, operational efficiency improvements, and the implementation of new technological advance in banking products. Both the market penetration and foreign banks act as a competitive force to domestic banks, pressuring them to reduce excess costs and profits and acquire modern technologies and techniques to improve the cost efficiency. For instance, compared to domestic banks, international banks operate with a relatively lower overhead cost and charge lower spread, hence promoting competition as pressure is put on other banks to lower their cost and spread. Consequently, this enhances the equality and availability of financial services and banking system in the domestic market. Foreign bank contributions to financial development and access to financial services of the host economy can induce growth in that country. The financial sector can benefit from the expansion of banking credit to the private sector, increased liquidity in the domestic equity market, contribution to a well-capitalized bond market, and broadening the country's access to international capital through parent banks.
Risk sharing is also an important benefit of financial integration. According to IRMI, risk sharing or risk distribution is defined as the process of which the premium and losses of each member of a group policyholders are allocated within the group based on a predetermined formula. These risks can vary from interest rate, unemployment rate, to inflation rate, etc. To answer the question of whether risk distribution can provide any benefit, Collateral and Crouch in 2010 conducted a study of financial integration benefit on the short and long run, and the result is the two graphs as you can see on the slide. On the first graph is the short run benefit of financial integration, in which the unit are exposed to short run risk, and on the second figure, the unit are exposed to the long run risk. The alpha measure the degree of home bias, and the gamma measure the coefficient of risk aversion. As you can see on the graph, on the when the alpha approach 0.5 is the risk would be too high to diversify. Thereby, the risk would be negating the benefit of financial integration. On this when alpha approach 1 and gamma approach 5, the benefit is maximized. The same is applied for the long run benefit. However, the benefit gained with long-run risk are significantly greater than those gained within short-run risk, and nothing can be gained as the degree of home bias approach 0.5. So this study has shown that risk sharing does have benefit both in the short and long runs. However, the long run generated the most benefit.
Yeah, we have known that the financial integrations has brought about many benefits, but we have to take into considerations their drawbacks too. So the problems is we have to enhance their beneficial effect and limit the negative effects on the economies of developing country. The following are some measures that we can take actions. In the field of state management organizations, we can improve the financial markets supervisory capacity to probably cope with changes in capital flow and contagion effect from a regional financial crisis. This will help to boost the productivity, improve the competitiveness of domestic goods, and encourage the developing countries to export. And secondly, in order to take advantage of tariff benefit, the government must assist the enterprises in meeting the conditions of origin, technical hurdles, and sanitary, and many more things else. As a result, the executions of obligations, the completion of a new generation's FTAs necessitates changes in domestic policy and legislations. And then we will move to the field of investing. The increased inflow of foreign money necessitates that authorities expand their ability to monitor capital inflows in order to minimize the possibilities of bubbles or significant capital outflow. You can assure that the company can observe investment money in the futures by doing so. And for the companies, the electronic transport change, we have to stick out and investigate information and understanding on the international economic financial integrations and about the international law too, And then the corporations must aggressively invest in and great technical equipment to increase the product qualities, because its product will be uncompetitive if they do not reach the international standard. Yeah, it is very easy, Thirdly, we have to enhance the qualities of human resources, particularly skilled professionals and highly trained personnel. Furthermore, active links between the enterprises are required, and is the development of cooperative plan to promote homes and a global market. Lastly, technical impediments as well as tight sanitary and phytosanitary systems might make it difficult for the goods to reach the market of FTA's partner. The enterprises compete with partner nations in the home market by supplying low-cost goods and high-quality services. By analyzing and clarifying possibilities and obstacles in participations in new generation FTAs. Yeah, thank you. So, in conclusions, what we have said, we have talked about the definitions, the history, the background of the financial integrations, and then we talk about the drawbacks, some drawbacks, but we focus more on the benefits of financial integrations. Our group opinions said that financial integrations will bring on many negative effects, but just on the short runs. But in long terms, it will help to drive the economies of a country. And lastly, we focus on the methods to strengthen, to help them to adapt to the financial integrations. Yeah, thank you for your listening. That is the end of our presentations.